In terms of the final example, let's look at central bank policy. And I'd like everybody that's on the webinar, there's a lot of talk in the financial news and media about, central banks are raising interest rates. But I'd like everyone to understand, why are they doing that? And what's the logic behind it? So this graph here, if I can show you, we have the years on the horizontal x-axis, and we have the percentages on the vertical y-axis, okay? These gray areas here are official recessionary periods. The red line here is inflation. So all I want you to think about is, as inflation rises, let's see what happens to the blue line, which is interest rates, okay? So we can see here in 1968, we saw inflation starting to rise, and the playbook of central banks is very predictable. They raise interest rates, okay? Now, what we see is when interest rates are risen, we get a recession. Because think about it, when you raise interest rates, you make the cost of capital higher. It sucks demand out of the economy. It makes credit expensive for businesses and consumers, and there's a slowdown. It's just unavoidable. Now, it does kill inflation. We do see inflation falling. But what happens again? Interest rates come down. The key point here is interest rates will always be cut in a recession, and that's valuable when we're looking into the future. We had the oil crisis in 1973, and we spoke about that. What happens to inflation? It rises sharply. And look at interest rates, they follow up. Interest rates follow up, and we get another recession. What happens in the recession? They cut interest rates, and inflation moderates for a period. And we had the 1979 Iran Revolution, Khomeini, and we had another oil shock, inflationary shock, and spike in inflation, and interest rates went up again sharply. And then we had the two sharp recessions in 1980 and 1982. And a lot of people on the call will remember that period. It was a pretty miserable period in Ireland, a lot of immigration. And this is important because economic policies have consequences. And if you think about it, it is a pretty blunt tool to defeat inflation. Essentially, it's just wreck the economy. Okay? So let's look to 2022 now. And what we see here is this, so people know what I'm saying, this is 2000, okay? And we had the tech bubble. People remember the technology bubble in 2000. And what I want people to look at is that look how moderate inflation is during this period. So inflation is the red line, and we don't really see a problem with inflation until the most recent period, 2021, okay? But what you will notice, we still had recessions. So we don't necessarily need high inflation to have recessions. So we can have a recession driven by speculation in technology. We can have a recession driven by speculation in real estate, which is what we had in 2008, and other issues like securitization and, greed in the system, etc. But the playbook is quite predictable. We get a period of speculative boom, recession, interest rates cut. Period of speculative boom, recession, interest rates are cut. We had COVID, which was technically a recession. But then look at this. We had this massive spike in inflation, which is huge relative to history, and we can see interest rates coming up. Now, people might be on the webinar saying, what's he talking about, interest rates and inflation? Because this is important when we're putting an investment strategy together, because when you see interest rates going up so high, and it's likely that we're going to get a recession, an inflation-induced recession, what do you think is going to happen to interest rates? They're going to fall.